Hello and welcome to What Goes Up, a weekly markets podcast. My name is Mike Regan. I'm a senior editor at Bloomberg.
And I'm Vildana Hajric, a cross-asset reporter with Bloomberg.
And this week on the show, well, this year's red-hot stock market finally cooled off a bit in August. That followed a blistering rally that saw the S&P 500 gain almost 20%, and the NASDAQ 100 climb 44% through July. So what are we to make of the market running out of steam late in the summer? Is it just that typical seasonal weakness when investors were all at the beach? Or is there something more going on? We'll get into it with a veteran market strategist. First, Vildana, summer's almost over. Do you have a good summer?
Well, we know that you think I was gallivanting around Europe, which I did for a little while. Yeah, that was fun. Otherwise, it just went by really fast.
I'm ready for fall. I'm ready for the cooler weather. And
I heard you're a big fan of pumpkin spice lattes.
Not at all. No.
Yeah, you love them, I heard.
No.
Mike Regan loves pumpkin-flavored stuff. PSL, pumpkin spice lattes.
Not at all. Not at all.
I wonder if our guest likes pumpkin spice lattes. He might. He's one of my favorite people to talk to. It's Art Hogan, Chief Market Strategist at B. Riley Wealth. Art, thank you so much for coming back on the show.
Thanks so much for having me. I'm very excited to do this.
Do you like pumpkin spice lattes?
Not really a fan. I like a lot of pumpkin things, but not the coffee-flavored pumpkin stuff.
I'm going to spread the rumor that both of you like pumpkin-flavored stuff. I'm going to tweet it.
You can't go spreading rumors, Vildana. You're a professional journalist. You've got to deal with the facts.
We need some controversy in our lives, so this can be it. But Art, to start, Mike mentioned at the top of the show that we had this blistering rally in the market. So I'm just wondering what you're expecting over the next couple of weeks. Do you think that we can continue to expect the market to digest the gains that we had seen coming into the fall?
Yeah, I think Mike made a really good point. And I think if you look back in history and say, what does the S&P 500 do when it gets off to a really solid start? And if you looked at the last 20 times that the S&P 500 was up 10% or more going into the mid-year, August and September have been rough months. That's why we call it seasonally tough. Sometimes it takes a little bit of a catalyst to remind us, but this year it didn't. We just flipped the calendar and August was just a bumpy road for all asset classes, but certainly treasuries. And I think that was part of the problem. Yields backed up, but we saw some pretty quick drawdowns. It was more noticeable in the 7 largest AI darlings, the Magnificent Seven, right? Which were off a lot more than the index was. But I think that what happens is you sort of look at this and say, okay, are these gains sustainable? To me, the more important thing that happened sort of post-Memorial Day and into this August and September timeframe is the market's really broadening out. And it's quietly getting some sponsorship for some of the underperforming sectors in the first 6 or 7 months of this year. And by that, I mean, it was all about technology, communication services, and consumer discretionary in the first half of this year. And all of a sudden, post-Memorial Day into August, we started to see energy pick up, which is great, right? So one of the biggest laggards in the S&P 500 is up 700 basis points over technology in the last month, right? And I think that's helpful. Industrials are up 300 basis points or 270 basis points above technology. So that catch-up trade is really important. And I set it up that way because I think that's what the back end of this year looks like. We can continue to have markets grind higher. I really think the trade is going to be about, hey, what didn't work in the first half of this year? And what should I be focusing on? And I think investors are looking for that. Now, the other piece of the puzzle that really worked well post-Memorial Day and continues to outperform is the Russell 2000 small caps. Big underperformer in the front half of the year, and I suspect they're going to outperform in the back half.
Art, towards the end of the month, obviously we got Jerome Powell's speech at Jackson Hole, and the market really seemed to take that as a positive. I'm not exactly sure what it was. He didn't seem to really break too much new ground. But is this sort of nascent rebound we've seen from the August volatility, is that all due to Powell, do you think? Just taking sort of the worst case scenario off the table when it comes to rates or what? Is it just a coincidence?
I think he had such an easy comp compared to last year, right? So last year it was Jackson Hole J. Powell, who just crushed the market, came out with a comically short speech and talked about how much more work they had to do, right? So in looking back and say, well, how much has changed year over year? I think J. Powell was a lot more comfortable saying, we just don't know. And we're going to have to be careful about it because they're getting to that last mile, getting headline inflation from 3% down to 2%, et cetera. And that's the tricky part because they don't want to overdo it and break something, which the Fed usually does. They don't want to underdo it and end up in a 70 situation where inflation comes roaring back. So I think he delivered the right message. I don't think he made any news necessarily. I think navigating by the stars in a cloudy sky was kind of the highlight for me. But I think if you combine that with the path of economic data that we've seen of late, and yields finally sort of calming down a bit, right? So if the Treasury curve calms down a bit and instills a bit more of a risk-on attitude, I think that has been helpful in the last couple of days. But it's only been 2 or 3 days in August where we've actually seen much of a rally, where most of the month we couldn't put 2 days together in a row. So I think it's, we continue to have a bit of a bumpy road in front of us. But I think the good news is we're going to put August in the rearview mirror, and September is going to come around, and we'll get through that as well.
That's such a good point about having the 2 days in a row, which is a stat one of our Bloomberg colleagues, Elena Popina, actually ended up writing about the other day. And it was just so surprising to me, just reflecting on that. So you mentioned the seasonality factor. I'm just wondering how much weight we really should be putting behind something like seasonality, where people just looking back at history say, okay, September tends to be choppy, October tends to be choppy. How much weight do we put behind those?
The way I think about it is, I think the seasonality piece of the puzzle is a good rule of thumb, but I don't think it's anything you change an investment decision for. I think it's important to know that historically there are months that are softer than others. And there's certainly cycles like the presidential election cycle that are important. But I think in general, it's more of a guidepost for you to say, okay, this may be the reason why we're seeing softness, but it's never going to be the reason that you want to change your long-term investment plans.
Art, you mentioned earlier Magnificent Seven, the big mega cap tech shares at the top of the S&P 500 is weighting, top of the NASDAQ 100 is weighting too. The whole frenzy towards AI has been kind of fascinating to me because, we're used to seeing something like that built entirely on hype. But in this case, the fundamentals seem to be coming in early, hand in hand with the hype. Every time NVIDIA puts out a forecast or its earnings release, it's like, wow. It's like, this is real here and now, fundamental improvement based on this AI theme, at least for NVIDIA, but I'm sure for others, the cloud service providers and all that. So how are you thinking about that, sort of separating the hype from the actual fundamentals in the AI plays? And where do you see it going? Like, to me, it almost feels like with stocks that big, market caps that big, and sort of this speculative frenzy around AI, it seems like kind of a dangerous combination for volatility potentially until we sort out the winners and losers of AI more completely and comprehensively. But I'm curious how you're thinking about sort of that hype combined with actual fundamental improvement so quickly in the cycle of something that's being hyped like this.
Right. Such a great point. And I think you set it up perfectly. I think when you think about anything new, the best analog for me is going back to 95 to 2000 when we think about the internet. Right. So the internet and .com revolution, and that was going to change the world. And what's interesting to me is that going back to that time frame and say, yes, 95, companies started coming public, and then it really got ahead of steam into 97, 98, 99. 853 companies came public, and most of them didn't even have business models, but they put .com at the end of their name, and we can remember all of those. And that virtually all of them are gone now, right? And virtually the winners in the internet cycle, and you and I using it on our daily basis, really didn't happen until 2005, right? So that total addressable market and that opportunity took the better part of a decade. So what's different now is, first and foremost, we haven't had just a flood of newly minted companies that are AI specific or have AI adjacency or have AI attributes, and that's good. So there's not that sort of speculative bubble in newly minted companies. I think that's very powerful and a big difference. And I think that's healthy. I also think the time is going to be compressed between when companies adopt an AI strategy as part of their business model and they monetize it. So I don't think we wait a decade to see this happen. We've certainly seen NVIDIA growing their revenues because they're making the only chip in town that really drives enough GPUs for companies to actually have that AI strategy. So I would say as an investor, the two things I would say early on here is to say, yes, this is new and exciting. We don't know how big this gets, but who are the obvious players? NVIDIA is obviously the leader here. And every time they report, they raise their quarterly guidance in billions of dollars. And while they're still the only game in town, and they are right now, and they've got the early early lead, they'll eventually get some competition. But for now, I think that's a safe place to be if you want to have some portion of your portfolio there. And then the two incumbents are obvious, right? The hyperscalers that can actually use this right away and afford to develop an AI strategy. So that's obviously Google and Microsoft, right? And they're every week they're going to come out with a different announcement and talk about how much they're going to charge for it. But the difference that makes in the near term for those two companies is much smaller than the difference that it has made for NVIDIA. So, to me, there's three obvious players, but I would overweight the guys that are selling the picks and shovels to the gold rush. And that's NVIDIA right now. And clearly it's what's amazing to me is it's a lot cheaper than it was when they reported their earnings a week or so ago. And you might have some better opportunities here. So they sharpen your pencil, but don't jump in and never put on a full position at one time and any of these things. But the biggest thing I'd be concerned about is if we start to see the capital markets open, we start to have a flood of newly minted companies that are AI specific or adjacent, I would avoid that at all costs because they likely don't have models. There's going to be a lot of hype around them. They're going to, get priced at 20 and a little bit at 60, and that doesn't end well for anybody.
It's like when a couple of years ago, a bunch of companies were adding just blockchain to their name.
Right.
I do have another question about the big tech companies for you. There was this really interesting report from Bloomberg Intelligence this week that said, looking over the past 5, 10, 15 years, there's only one equity mutual fund that has outperformed QQQ, which is the giant NASDAQ 100 ETF. Just one has outperformed QQQ over that time frame. And it's because they had a heavy weighting towards Tesla. I'm just wondering what you make of something like that and just how difficult it's been to beat these giant companies that have just been doing so well.
Yeah, any time frame that you look at, you're always going to see a high percentage of active managers, whether they're running mutual funds or just have asset management firms or have their own funds, beating the market, and especially a market that is driven, at least over the course of the last, call it 2 or 3 years, by the 5 or 10 largest names in the S&P 500. Now, that's nothing new to us, right? If you go back for the last 50 years or at least 30 years, you can pick every decade and say, what were the top 5 names in the S&P 500? And it's just the names change. But the size, because of the way the S&P 500 is made up, and it's a market cap weighted index, they always have an outsized impact on the overall index. And it used to be companies like ExxonMobil and General Electric and AT&T. And over the years, that's kind of obviously shifted over to companies like Apple and Alphabet and Facebook. And I think that that's going to change again, 10 years from now. But I think in general, that the sort of active management versus passive management or active versus ETFs is a very difficult game to play. And it's very few, folks have had a long-term record of beating, right? And I'll ask you a question. Name for me a hero of yours that is a long-only fund manager. Because when I was your age, I would have 5 names for you.
This is a trick question, right? Because there aren't.
If you can't name any, then there's none in your life, right? So, when I started the business, Peter Lynch was a rock star type portfolio manager and had, outperformed for years. But nobody was invested in the market. Nobody could buy the triple Qs or the spiders. We just didn't have as much passive back then. So it's made that role that much more difficult. Warren Buffett, I suppose, falls into that category, but different investment style. But, for years and years, you would have your favorite long-only portfolio manager at the tip of your tongue. And right now, I can't find anybody that just has that answer for me right away. Mike?
Well, Art, I'm glad you brought up Peter Lynch. I actually have a Peter Lynch related question for you because I was reading one of your notes and I found this interesting. You wrote, we foresee a path to S&P 500 earnings of $230 for 2023 and $250 in 2024. Now, this is what I find interesting. Using a 20 multiple on the blended earnings of 240 gets us to 4,800 for the S&P 500. I'm curious how you got to that 20 multiple, because I always think back to Peter Lynch and his rule of 20, that the multiple plus the rate of inflation in a fair market should equal 20. Now, there's plenty of examples of it being below and above that. But it does kind of average out to that, interestingly.
So unfortunately, for the last 10 years, if you applied the rule of 20, which is a discipline that I've always tried to use, you would have been out. You would have been out of the market for most of the time. Part of that was the fact that we had, very low inflation, and then we shifted to very high inflation over a very short period of time. So I think that what I tried to do is take, and that 20 multiple was obviously a trailing multiple, not a forward multiple. So it's a, I think that makes it a little bit easier to sort of justify. And I said, what does that multiple look like on the end of the year for the last 5 years? And that's at or about where it is. In my role as a strategist, you have to come up with a number. And I was at 4,400 and everyone thought I was crazy in January. Having to have something in print and not having people saying, oh, so you think the market's going down? I just kind of rolled out to what we think 24 looks like. And we're confident in that estimates we have for both this year and next year, because after the second quarter earnings reporting season, the estimates went up, not down, which is, doesn't always happen. And we saw no degradation of the 24 estimates, which is a positive. A lot of that can change. It is a moving target, but you're right. It is it was difficult to type that number when I put it down, but I felt a little more confident because it's kind of looking out a bit further and using what the average was for the last 5 years.
Yeah, well, that's the thing, though. It does seem like a reasonable multiple in this day and age. I guess I've been kind of surprised that this acceleration in inflation and interest rates hasn't knocked the multiple down further. Is the multiple just signaling that the market believes inflation and rates are going to normalize back to pre-COVID levels, do you think?
I don't know if they believe that they're going to normalize back to pre-COVID levels, but they certainly believe they're heading in that direction, right? So, we had headline CPI going from 9% to 3%. Obviously, we're heading in the right direction. So no one's going to use, what inflation was 6 months ago or 3 months ago. They're going to use what they think it's going to be in 6 months. And I believe it's going to have a two handle, especially if we start to get shelter costs in line with reality, right? The government uses something called owner's equivalent rent, which has got a lag of 6 to 12 months because they kind of survey, right? But if you look at, any of the other real-time data, like Zillow or Redfin or any of the folks that give us that real-time data, we know that that's off by a bit. So I think the inflation numbers just naturally have more to come down. And I think that helps sort of justify a bit of a higher multiple than we normally would have if, in fact, you and I were still using the rule of 20 and subtracting, the current inflation rate. So I think that's where the difference lies. The other thing I think about too is, we talk about the S&P 500 net multiple, but any one of those 5 years, if you were to back out the top 10 stocks, the multiple has been at or about 15, between 15 and 15 and a half. And it continues to be the case. So again, that's the tricky part about having 500 stocks where the 10 of them have the most influence and are attributed much higher multiples because they have much higher growth rates in general.
So speaking of different ways to look at valuations for the market, I actually had called you about this a couple of days ago because I was trying to find a different way of measuring the rally that we had seen in the S&P 500 so far this year. So if we take the S&P 500 market cap and we divide it by nominal GDP, or if we take it and divide it by CPI, the gains just aren't as great as, whatever we had risen as much as 20% this year, nearing those all-time highs that we had seen at the start of 2022. It's just not, there's just much further to go to reclaim those highs.
I think that's such a great exercise because what it tells you is two things in my mind. I think it tells you that the Fed that has, 1,000 economists looking at markets probably feel a whole lot more comfortable with how far we've come during what they've been trying to do is kind of tighten financial conditions because they can live in a nominal world, right? They can say, okay, the market's up, but not when you factor in GDP or if you factor in inflation. Now, you and I and the rest of the investing world likely get our wealth effect from the notional gains that we have, right? So if I bought Apple at $50 and the sell where it closed, I don't factor in inflation there. I factor in my gains and say, okay, I feel this much more wealthy. So the wealth effect can actually be in place for the gains that the market have had notionally, while the Fed can rest a little easier as they look at the gains nominally. And I think that's the difference when you look at that exercise. I thought it was a great question. And believe me, when I think about this more and more, I think it helps the Fed feel more comfortable that financial conditions aren't quite as tight or as loose as they feel like they are. Everyone has this feeling. I'll make an analogy for you. So everyone thinks the Fed thinks about the stock market more than they actually do, right? We all believe it's like, oh, if the Fed sees the market go up as much as it has, they're going to keep tightening. I don't think they give it as much thought. And then I always try to equate that with, I'm a Red Sox fan. And I assume, I assume everyone in New York hates the Red Sox as much as we hate the Yankees, right? But I think the same way the Fed looks at this, right? So I think if the Fed's like, yeah, whatever, that's the market over here. I think the Yankees fans are like, yeah, it's just the Red Sox.
We don't think about you guys.
Right, exactly. You're not that passionate about how you feel about us. And I think the Fed thinks the same way as Yankee fans do about the Red Sox, about the market. And especially if they can use that, hey, if I compare this to inflation or GDP, I feel like the market's actually gone up less.
Art, you've written that you favor a quote unquote barbell approach to investing, with one end focused on things we need versus things we want. Talk to us a little bit about what you mean by that. That's an interesting concept.
Yeah. So things that pretty straightforward. The things we need: healthcare, right? Things we need: energy. Things we need: staples, right? Those types of things. And I think about that in that bucket. And if you were to balance that off with things that you want, typically you're going to find that in a lot of the growthier names for a lot of reasons. And when you set this up at the beginning of the year, it's not a set it and forget it. So you've got an equal weighting on either side of that barbell. And every quarter, when you rebalance, you're literally selling some of your winners and buying some of your losers. And if you were to take that, and we ran the numbers last year and then the 6 months of this year, you kind of look at this, it's kind of a disciplined way of staying diversified and balanced. And you actually put money into energy at a great time, and you took some profits in technology at a very good time. So it's very much of those, I want the Apple 15. I don't need it because I've got an 11 right here, but I want it. Those are the things that I want. Things that I need, I certainly need healthcare, and I certainly need energy. And to a certain extent, which hasn't worked yet, but I believe it's going to, as I look at one of the other laggards, I think financials fall into that category. But there's so much noise around, what new regulations are going to look like and when net interest income improves and all of that. But I think that's probably one of the cheapest spaces in the S&P 500. That's one of our three in that basket. It's energy, healthcare, and financials. It used to be staples, but they got too expensive. They're getting better now. But on the other side, it's pretty obvious, where we'd be on the growthier side.
Well, how does the Fed play into what we can expect from the market going forward? Like how high is the bar for a September hike? And what else do you expect from the Fed?
The good news is this time of year, the Fed's had a couple of long breaks in between meetings, right? So you got July meeting, September meeting, no October meeting, and a November meeting, right? So you've got that sort of, on again, off again Fed. So it's less of a concern. So we put less attention on every single data point, which I think is always a mistake. So nobody is going to use any one single data point and say, oh, this means the Fed has to do this, right? I think the consensus has it about right that there's about a 20% chance that they might raise by 25 basis points in September. I don't think they're going to. But then they've got this whole plethora of data that they get to see before they meet again in November. And I think that's a real positive. I think that there's a chance that the path of inflation continues apace, that they will feel that they've made significant progress toward their symmetric 2% target. And we may have seen the last of the rate hikes. Now, another rate hike, if they do go in November, is not going to sort of break the market, but I certainly think they've already gone far enough. I think there's really long lags in monetary policy typically. And I think that the lags are much longer right now in the here and now. And the reason I say that is the majority of consumer debt is tied up in mortgages, and the majority of that's below 4%. So nobody has felt the bite of higher mortgage rates unless you're one of the new home buyers, right? So, you haven't really felt this. 40% of the S&P 500's debt doesn't have to be repaid until 2030. So corporate America is not feeling the bite either. I think everyone sort of looked at this like you refinancing lower. Corporate America looked at this and said, okay, I'm pushing my duration out at these low rates. So both the consumer and corporate America haven't really felt the bite of all of the monetary policy that we put in place. Now, around the edges, obviously everyone has, and a new home buyer has to pay 7.4% for a 30-year fixed. That's taking a bite, but it's not taking a bite on the majority, right? The majority of consumers that have debt that they're probably not going to roll over. So I think that causes an even longer lag in this monetary policy process. I think we've seen the last of the hikes, and I think the market celebrates that. We get a pause in September. That's consensus. That's not a surprise. If we don't get a rate hike in November, I feel like that's going to signal that they're getting closer to where they need to be. The real question won't be how high anymore. It'll be how long. And consensus now has it way out to the second half of next year. I think there's a small number of people who think June there might be a cut. And I think that the talk about when they cut really has to do more with, are they over restrictive now, right? So if we start to see the path of inflation come down at the pace that it's been coming down, and they're sitting at 5.5 in the Fed funds rate, and there's a 200 basis point delta between the current inflation rate, that's going to be overly restricted. And the reason that they'd want to cut is to get that somewhere between 150 and 175 basis points. Doesn't have to mean the wheels are coming off the cart because they're cutting it. It just means that, hey, we're restrictive enough. And Jay Powell at his last presser, not Jackson Hole, but at the last meeting, even said, we wait till we get to 2%. We've waited too long. We have to start adjusting policy and become less restrictive to normalize rates. So I think that happens in the back half of next year. The market has kind of sniffed that out. And I think that, we're setting up, in my mind, this August and September period is really setting up nicely for a year-round rally. And why do I say that? If you look at all the survey data, so whether it's the AAII, the first time it's been bearish in 12 weeks was this week. People are waking up and saying, okay, something's going on here. The individual investor survey, outrageously low, the lowest we've seen it for the year. So sentiment is starting to wind down. We're starting to wind down a lot of the positioning, the bullish positioning that we sort of exited July with. And the sentiment is rolling over nicely as well. So it's funny how a sloppy August can kind of change that mindset and kind of get us reset back to something more realistic. So the more these surveys start to read bearish, the more confident I feel that we're setting up nicely for a run into the end of the year.
Well, Art, as you know, life is full of surprises. Who would have thought we'd ever be looking at the Red Sox and Yankees battling for last place in the AL East? I hate to throw that out. You do have bragging rights over the Yankees this year, at least, though. I think he's still got about 10 games up on the Yankees. If I were to summarize your outlook, I would say you're pretty bullish, kind of in the soft landing camp. I think the market's set up for a nice year-end rally. But what worries you? What's your main risk that you would be either surprised or not by? But, what's sort of the surprise that would sort of turn your sentiment around?
China becomes Japan and goes through a lost decade, right? So China went through a different sort of pandemic experience. Most of the developed world went through this sort of longer than we expected, but lockdown, reopening process, a lot of stimulus, and we're able to sort of go through a very, very much of a V-shaped recovery. And China just hasn't experienced that. So they've, after 3 years of on again, off again, they're trying to reopen, never stimulated the consumer, and they're really, turning into a consumer-driven economy. So it's not as though there's a big savings rate by the Chinese consumer. That's important. Their demographics are getting older. That's difficult. And what we haven't seen yet is the typical China state government stepping in and stimulating. They're doing some things around the edges that aren't really effective. But without them fixing some stimulus and driving their economy to get anywhere close to their 5% GDP goals, the global economy is not going to have the kind of recovery that we're anticipating, right? The reopening of China was going to drive demand for goods and services globally, and it just hasn't happened yet. So that would be the biggest thing. I don't think they have a lost decade, and I do think they get back to the normal patterns, but they've got a lot of things they have to deal with. Pile of debt, really bad real estate, holdings all across the board, on again, off again relationships with the United States. So we'll have to wait and see. That's probably the closest to a black swan that kind of is out there, I think.
Yeah.
And then anything else that sort of significantly disrupts the supply of energy, because the supply and demand dynamics are really pretty tight right now, right? So
yeah,
Russia's pumping as much as they can, and they're not sort of operating with OPEC, but OPEC wants to keep prices at or about, $100, and here we are at $80. So if OPEC really gets religion and decides to really crank it down, and we don't see an increase in U.S. supply, which we are. I mean, we're gradually pumping more every week. We'll probably be at a record in the first quarter of next year. But if something were to disrupt that, that'd be the second thing that would be out there, because that hurts everybody.
I'm glad you brought up China. Is it surprising at all to you to watch all these credit issues in China? Country Garden, Evergrande, all the developers are basically underwater on all these construction projects, very aggressive development projects they were engaged in. Is it surprising to you that that's not a bigger theme in the U.S. and global markets right now? I mean, not too long ago, any hint of weakness in China would really trigger some risk-off mood in the U.S. market. Is it surprising to you, or have we sort of decoupled enough due to all the deglobalization that's going on that China is not as big of a catalyst as it once was?
Yeah, I would say yes. I am surprised. I think that we've got a strong enough muscle memory for China to always step in and do something that helps drive their economy. And I think that's what we're counting on now. So I think they got sort of a mulligan for the pandemic for 3 years. It's like, okay, they're being hyper vigilant, not reopening. That's really hurting everybody. At the same time, we realized how fragile our supply chains were, as did everyone else, and started finding other places to get supplies from. So they're losing that, but they're still in the middle of this sort of generational change from bringing folks from farms into cities, and they overdid what they built, right? So that's where the real estate problems got into. Imagine moving, over an 8-year period, 600 million people into a city the size of Boston that you just built a month ago, and then finding them all jobs, and then shutting the economy down, but not sending them checks, right? So that's kind of the difference when we think about what they're going through. I think the world is waiting for that announcement. They're waiting for China to say, oh, and we're going to do this, and we're going to do this, because that's just what we're used to. If this is a different type of China and they're willing to say, we don't have a 5% GDP growth goal, and we're not going to stimulate anymore, we are, and we're trying to do a workout of all this, commercial real estate that's a disaster. Yeah, I think that's a big dent. You can't imagine that the second largest economy in the world doesn't have an impact if they're going to, go into a recession or have very slow growth over the next few years.
Art Hogan, Chief Market Strategist at B. Riley Wealth. Art, such an honor and a privilege to hear your thoughts. Can't let you go just yet, Art. We do have a tradition here on What Goes Up where we've got to get your craziest thing of the week. Vildana, let's start with you, though.
Okay, mine is a Bloomberg story that was, I think, very well read. The headline is, Citadel vets 69,000 intern applicants to find the next math geniuses. So they have 69,000 applications. And guess how many people they actually accept per intern class?
200.
It's so tiny.
20.
14.
Easier to get into Harvard than it is to get into Citadel.
That was the craziest thing I saw. I mean, you just stand no chance.
Yeah.
There's got to be some AI involved there in sifting through all those applications.
Probably.
Apparently, there was a story out earlier in the week that said that they make $120,000 fly business class and stay in 4-star hotels.
Not bad right out of college, yeah.
It does sound really nice.
That's pretty good. All right, well, that's a good one, Vildana. Art, how about you? You seen anything crazy in the last week or so?
Craziest chart that continued to float around the street this past week and continues to bother me a touch was that the total credit card debt was at a record high and no one ever put a denominator on it. Right? Everyone's like, okay, alarm bells, it's $1 trillion. And, we never say what the U.S. debt is without saying to GDP. But it's okay to say consumers have this much debt, but not put a denominator on as compared to what their total savings are. And if you just use that, no one would ever read the story because it sounds so much better to say there's $1 trillion in credit card debt. But oh, by the way, delinquencies are not even back to where they were in 2019. And as a percentage of total savings, they are completely average. So it's the frustrating chart that comes out here. We call that a chart crime, and it was one of the chart crimes of the week.
Yeah, I mean, that excess savings from the pandemic has really been the story for the last few years. It is sort of normalizing, though, right? I mean, how big of a headwind is that, do you think?
Well, I'll tell you this. So just to put some context around that, if you went back for the last 25 years and said, what's the per capita GDP, per capita personal savings rate? It's always similar, about 5%, between 5 and 5.5%. Yeah. 25-year average, always has been. Got to 18% during the pandemic. So not only are you getting money, but there was nothing you could spend it on, right? There was virtually nothing you could do. So obviously that had to work down. And guess where it is now? It's at 5%. So the fact that we're back to normal, now if we went from 18 to 3% and credit card as a relationship to personal savings was some percentage that we haven't seen forever, then I'd be more concerned. But I think we're normalizing some post-pandemic abnormalities. And I think the personal savings rate is one of those. So as a headwind, I think I would focus more on the fact that wages for the last 2 months have increased more than inflation. And it took until 2 months ago for that to happen. So that likely is the silver lining in what could otherwise be a cloud there.
It all sort of reverts back to just that job market staying strong. It seems to me is always the most important variable, right? As long as we're seeing this low unemployment claims, low rate of unemployment, solid growth every month. I mean, that seems to be the whole story these days when it comes to the economy.
Yeah, we as Americans, since World War II, spend our income statement, not our balance sheet, right? So if we have a job, that's what we spend, right? And we don't think about necessarily the value of our house, or we don't necessarily think about, those are things we put into confidence. But we really, do I have a job, or could I get one if I needed one? And that still feels like a relatively high number. And, when I started the business, anything below 5% unemployment was full employment. So we've ratcheted that down to 4%, I guess, now. And, to look at that, it's hard to predict some terrible things happening at 3.5% right now.
All right. Good stuff. I'll give you my crazy thing. This is courtesy of the Independent newspaper, the British newspaper. It's in the commodities market, if you will, Vildana. I think this counts. The world record for the most expensive cheese has been broken.
Wow.
The most expensive cheese is Cabrales blue cheese from northern Spain. Well, let me tell you a little bit about this cheese. It's aged in a cave.
Wow.
At 1,400 meters for like 8 months. It could be cow's milk or a mixture of cow's, sheep, and goat's milk. And they put it up in a cave at 1,400 meters, pretty high up there, at a temperature of 7 degrees Celsius. And it needs to spend a minimum of 8 months there. And then they bring it down and they auction it off. So, Art, you're now a game show contestant on our little game show here. The price is precise. 2.2 kilogram wheel of Cabrales blue cheese from northern Spain. Most expensive cheese ever sold. Guy who owns a restaurant bought it. What do you suppose the price was for 2.2 kilograms?
$15,000.
$15,000. So that would be what, about 12? Of course, this is the Independent, so they give it in British pounds. So what, it's like 12,000, something like that.
12,001.
Ah, you're $1 over?
Yeah, because I was going to say 20,000 originally, but yeah.
30,000 pounds for this wheel of cheese.
It's worth it. I'm sure it's worth. This cheese sounds wonderful.
I did not have this on my bingo card, Mike. That was
It's the same restaurant owner had bought the previous record holder for most expensive cheese. So sometimes I wonder if there's a little publicity stunt going on with some of these, I've come to my restaurant. I've got the world's most expensive
If that's
cheese.
a PR stunt, it's a pretty cheesy one, Mike, I think.
All right. Art gets the joke of the show, I guess. Could have seen that one coming down Fifth Avenue, but still got me. Art Hogan from B. Riley Wealth. Such a great time as always, Art. We appreciate it and hope we can talk to you again soon.
Sounds great. Thanks, guys.
Thank you, Art.
What Goes Up will be back next week. Until then, you can find us on the Bloomberg terminal, website, and app, or wherever you get your podcasts. We'd love it if you took the time to rate and review the show on Apple Podcasts so more listeners can find us. And you can find us on Twitter. Follow me at Regan Anonymous. Vildana Hajric is at Vildana Hajric. You can also follow Bloomberg Podcasts at Podcasts. What Goes Up is produced by Stacey Wong. Thanks for listening. See you next time.